Nearly half of all Georgians hold loan debt, and a further 1 in 5 struggle to make their loan payments. Taking out loans, especially in times of economic uncertainty, are a considerable risk, or as one could say, a gamble. Considering this, today we're asking what are predictors of loan taking behavior in Georgia, and is a habit for gambling one of them? Welcome to the CRRC-Georgia podcast. Today we'll explore these questions by diving into findings from the comprehensive CRRC-Georgia study authored by researcher Tina Banzeladze, Loans and Gambling in Georgia, Findings from a Survey, published in October 2024. This research offers valuable insights into factors that drive both borrowing and gambling behaviors in Georgian society, revealing surprising connections between these two forms of financial risk taking. The study was supported by the National Endowment for Democracy and provides crucial data on how Georgians navigate financial decisions in an increasingly challenging economic environment. Before we explore the findings, let's examine the methodology employed in this research. The study utilized computer assisted telephone interviewing with a simple random sample generated through random digit dialing. The research team collected 1,234 completed responses between March 11th and 14th, 2024, with a margin of error of 1.6%. The data was carefully weighted to ensure national representativeness of Georgia's Georgian speaking population in Tbilisi, other urban areas, and rural regions. The survey questionnaire was comprehensive, measuring loan patterns, demographic characteristics, gambling experiences, attitudes toward government market regulation, basic accounting skills, financial planning abilities, and self assessed risk taking behaviors. The study included an experimental component that tested how different presentations of loan information affected decision making. Respondents were randomly assigned to receive varying levels of detail about loan terms, allowing researchers to assess how information framing influences borrowing decisions. The central premise of this research challenges us to consider whether gambling is a predictor of taking out a loan and vice versa. Both activities involve risk taking, uncertainty about future outcomes, and potential financial consequences. The data reveals intriguing parallels in the psychological profiles of those who engage in these behaviors. In Georgia, 41% of the population holds loans of up to 5,000 lari, while 7% have loans exceeding 50,000 lari. Consumer loans dominate at 43%, followed by installment loans at 33%. Interestingly, only 8% of the population reports having gambled in the past year, with just 1% reporting gambling daily or almost daily. A small connection appears when examining risk profiles. The study found that individuals who self assess as risky are 5 percentage points more likely to have mortgages and 6 percentage points more likely to have other types of loans compared to those who describe themselves as cautious. Similarly, these same risk taking individuals are 5 percentage points more likely to have gambling experience. However, important to note is that those surveyed self assessed their own level of risk taking behavior, which may actually differ in reality. The research reveals distinct demographic patterns that govern both behaviors. Men are significantly more likely than women to both gamble and hold certain types of loans. Age plays a crucial role as well, with those aged 35 to 54 most likely to have mortgages, while younger adults aged 18 to 34 are more prone to gambling. Education creates an interesting divergence. Higher education levels correlate with mortgage ownership but inversely relate to other types of loans. This suggests that mortgages represent strategic, long term financial planning among those holding a higher education, while other loans may indicate immediate financial pressures among those who do not. Across geographies, the rate of having taken out a loan in the past few years is high. Among those in rural areas, 73%, 63% in Tbilisi, and 67% in other cities. On the other hand, 9% of those in Tbilisi report having gambled in the past 12 months, compared to only 3% in rural areas and 7% in other cities. Again, important to note, as this is self reported and gambling behaviors are typically frowned upon, the actual rate of gambling may be higher. This study illuminates the economic pressures driving Georgian borrowing. The primary reasons for taking loans are household expenses, health issues, and paying other debts, each accounting for approximately 20% of borrowing motivations. Only 2% borrow for travel, indicating that most loans address basic needs rather than discretionary spending. After making monthly loan payments, 39% of borrowers have enough money for food but not clothing, while 17% struggle to afford food. This data suggests that many Georgians are using loans not for investment, but for basic survival. One of the study's most revealing findings concerns financial planning skills. Researchers created an index measuring respondents' long term budgeting abilities and future oriented decision making. Those with poorer financial planning skills were more likely to have non mortgage loans and significantly more likely to gamble. Specifically, impulsive individuals who engage in short term planning are 13 percentage points more likely to gamble than cautious, long term planners. This suggests that both gambling and certain types of borrowing may reflect similar underlying cognitive patterns related to temporal decision making and risk assessment. The study also examined basic accounting skills, expecting these to influence financial decisions. Surprisingly, mathematical ability showed no significant relationship with loan taking or gambling behaviors, suggesting that emotional and psychological factors may override analytical capabilities in financial decision making. The experimental component of the study provides crucial insights into how information presentation affects borrowing decisions. Researchers presented loan scenarios with varying levels of detail: basic terms, total repayment amounts, and potential sanctions for non payment. For consumer loans, additional information had no significant impact on decision making. However, for mortgages, providing information about expected sanctions for default reduced the likelihood of taking out a loan by 5%. This finding suggests that people may not fully consider the consequences of borrowing until explicitly confronted with potential negative outcomes. This mirrors gambling behaviors, where individuals often focus on potential wins rather than likely losses. The parallel suggests that both activities involve cognitive biases that minimize attention to negative consequences while emphasizing potential benefits. The research reveals important cultural dimensions to these behaviors. Religiosity, measured by frequency of religious service attendance, significantly reduces gambling likelihood. Interestingly, attitudes toward government paternalism also influence borrowing patterns. The majority of Georgians, 70%, believe the government should care for them like a parent. Those favoring greater government control of businesses are more likely to have non mortgage loans, possibly reflecting reduced personal responsibility for financial outcomes. So, can a gambling habit predict one's likelihood of taking out a loan? The research suggests the answer is nuanced. While both activities involve risk taking, it appears they serve different functions in people's lives. Mortgages appear to represent long term investment decisions among those holding a higher education and those that are employed. Other types of loans, however, show stronger parallels to gambling behavior, often reflecting impulsive decision making and immediate financial pressures. The study's findings have important policy implications. The experimental results suggest that mandatory disclosure of loan consequences could reduce harmful borrowing, particularly for mortgages. The connection between poor financial planning skills in both gambling and non mortgage borrowing indicates that financial literacy programs might address multiple risky behaviors simultaneously. Perhaps more importantly, this research highlights the complex interplay between economic necessity, psychological traits, and social norms in shaping financial behavior. While some borrowing may indeed resemble gambling in its risk profile and psychological drivers, we must be careful not to characterize all debt as irrational behavior when economic circumstances often leave people with limited choices. Understanding these connections can help policymakers design more effective interventions to promote financial well being while recognizing the role and impact both credit markets and gambling play in modern society. Thank you for joining us for this exploration of financial risk taking in Georgia. The parallels between borrowing and gambling behaviors offer valuable insights into human decision making under uncertainty, reminding us that our financial choices reflect not just economic calculations, but also other psychological and social influences. You can find articles and reports used for this episode in the episode description and on our website, crrc.ge. And you can follow us on social media at CRRC-Georgia. Until next time.